Everyone gets kind of like envious because they see all their friends making a lot of money and they see all these random people on the internet making a lot of money. Dividends that you get from REITs are typically taxed differently than the dividends you get from regular stocks. These mutual funds don't always outperform the market. What's up everybody, I am Jaspreet Singh from theminority-mindset.com, where money minds rethink rich. Dividends are one of those few places out there where you can really get that passive income, because once you own a stock that pays you a dividend, you don't have to do anything. This company will continue to pay you. Now the question is, how can you be a full-time dividend investor? Meaning, how can you live off of the money that your dividends are paying you? That way your companies can work to make you money and then you can go off and do something else. Well, that's what I'm going to be going over in this video, because I got some of our best clips where I talk about that. So let's jump into it. The stock market has become a very popular place for people to start trading and investing their money, but making money in the stock market isn't as easy as some people make it seem. That's why they say the fastest way to become a millionaire in the stock market is by starting off a billionaire. That being said, even though the majority of people lose money in the stock market is still the most accessible wealth building tool that the majority of people have access to, and the stock market is still a great place for you to build and store your wealth if you understand how to invest your money in the stock market the right way. But before we get into that, I need you to do me a quick favor and smash the thumbs up button below. And if you haven't already, you can join our free Discord server. That way you can chat with other minority mindset thinkers. Our Discord chat server is completely free. We call it the Guac Talk server because when you're in our community, we talk about all things minority mindset. We talk about the stock market. We talk about the real estate market. We talk about crypto. We talk about how to manage your money the right way. And we talk about how you can build wealth strategically. So if you want to join our free community on Discord, the Guac Talk channel, you can join it by clicking the link in the description below. If you want to be a successful stock market investor, there are 7 things you need to understand. The first thing you got to understand is, what is the stock market? Why does it exist and how does it work? Then you got to understand the different types of investments on the stock market. Like you have stocks, you have ETFs, you have index funds, you have REITs, you have dividend stocks. You want to understand what the different types of stocks there are. Then you want to go over how you can actually buy a stock and have the right strategy for investing your money in the stock market. And then you want to know, how do you actually find a good investment? How do you research stocks? What do you need to pay attention to? Then you need to know, how do you actually make money? Sometimes you can make money when a stock price goes up. Other times you can make money just for owning a stock without selling it, because some stocks are going to pay you just for owning them. This is called dividends. I'm going to be talking about that. Then you got to know, when do you sell your stock? When is the right time to exit? And then you got to know, when you start making money, you got to understand how to pay taxes, because anytime you make money, you're going to have to pay taxes. So you want to understand that. These are the 7 things that I'm going to be going over in this video. So let's start with number 1. One of the easiest ways for me to help explain what the stock market is by explaining what the stock market is not. The stock market is not a casino. The stock market is not a gambling center. Now, some people do use the stock market as a gambling source. Some people do use the stock market as a place to go gamble their money, but that's not what the stock market is. The stock market is a place where you can go and buy ownership in some of your favorite companies. Let's assume that you have a really amazing guacamole recipe. And because your guacamole recipe is so amazing, everybody wants your guac. So now you start selling your guac to stores in your neighborhood, and you want to expand to other places. So now you get an investment from investors, and now you have the money to expand operations. Now you can sell your guac to stores all over your state. And now you want to expand even more, so now you raise on some debt, and now you're selling guac in a dozen different states, and now you are killing it. You are making millions of dollars, you have a whole bunch of money, but you want to keep growing. And you don't have the way to keep raising all this money, because you don't want to keep going out and finding more investors. You don't want to keep raising more debt because you already have a ton of debt. One of the things that you can do now is you can go public on the stock market. This is called an IPO. IPO stands for initial public offering. And what this means is you are going to take a portion of your company and you are going to sell it to the public, regular people like you and me. And now it is much easier for you to raise money because you can just sell a portion of your company to the public. Now, it's not easy to go public, but once you are public, it is easier for you to raise money because you can sell a big chunk of your company to the public and you can raise a lot of money doing that. And so when companies go public, one of the big reasons for that is so they can raise money. That way they have more cash in their pocket. That way they can hopefully expand, grow, do whatever they want to do to help build the business. Or maybe they just want to be able to liquidate some of their ownership and have some cash in their pockets. You might have heard somebody say something like, on average, the stock market grows by 8 to 10% a year. Now, while that might be the case, that does not mean that the stock market goes up like this. You see a cyclical kind of swing in the stock market, which means over time, you see the stock market kind of go like this. Yes, over time, the stock market does on average grow by 8 to 10% a year. That's what we've seen over the last century. But that doesn't mean that the stock market grows straight up. You see these kind of swings. You have times when the stock market is going up, that's called a bull market. And then you have times where the stock market is going down. That's called a bear market. And other times you also see the stock market going sideways. That's called a sideways market. But you're going to see different types of kind of swings and movements in the stock market. And you got to understand, that's just the way the stock market works. Because what happens in the stock market is you have a lot of traders, short-term people investing their money in the stock market who are trying to make their money quickly, who get very emotional, and they're paying close attention to these swings because they're trying to make money quickly. And so that's when you get to see people who are greedy, who get emotional, who get fearful. But if you want to be a long-term investor, you want to understand how the stock market works, because one of the most iconic sayings by Warren Buffett is, be fearful when people are greedy and be greedy when others are fearful. What that means is when everybody is panicking and selling when the stock market is going down, that's when you want to be coming in and buying, especially as a long-term investor. And when everybody gets greedy and everybody thinks that the stock market cannot go down because everybody's making so much money, that's when you want to start taking a step back and be a little bit fearful, because when people get greedy and all they see is profits and they don't take any risk precautions because they think the stock market will always keep going up, that's when you want to take a step back, because nothing can go up forever, not even the stock market. And so you want to remember that as an investor and understand that, yeah, you're going to have bull markets, you're going to have bear markets, you're going to have sideways markets. These are all parts of the stock market, and these are things that make the stock market whole. Now, once you dive into the stock market, there's a lot of different investment options that you have. Like, the most obvious option is you can invest in stocks. When you invest in a stock, you're investing in an individual company. So if you go out and you buy one share of the McDonald's stock, you are buying one piece of ownership in the McDonald's Corporation. Now, if you just have one share of the McDonald's Corporation, you don't get to tell the McDonald's Corporation what to do, but you do get to share in the profits when McDonald's makes money. So if you go out and you buy shares in McDonald's or Tesla or Lululemon or Chipotle or Apple, you become one of the owners of these companies. But if you want to invest in stocks, you have to be doing some research on these companies. Like, before you invest in a company, you want to make sure that this is a good investment and that this investment is going to hopefully grow, because the last thing you want to do is go in and put all of your money into a company that is losing money and that has been losing money year after year after year just because you didn't do your research. So when you're investing in stocks, you have to do that research. But if you're not interested in doing that research, then you can also invest in something called an ETF. An ETF stands for Exchange Traded Fund, and you can think of an ETF kind of like a basket of stocks. Now, instead of investing in just one company, you can invest into a basket or a fund that gives you exposure to a whole bunch of stocks. For example, there are a couple ETFs. One is VOO, the other is SPY. These two ETFs give you exposure to the top 500 companies in the stock market. So the S&P 500 is a list or a group of the 500 biggest companies on the stock market. And instead of you going out and individually investing in all 500 of these companies, you can invest in one of these ETFs and then you'll get exposure to all 500 of these companies. Now, you don't have to worry about trying to find the perfect company or doing research on all of these companies. You are just investing in these ETFs and now you're getting exposure to the general stock market. If the stock market goes up, generally these funds will go up because now the biggest companies in the stock market are probably going up too. Index funds work very similarly to ETFs. The difference between index funds and ETFs is you can buy and sell shares of ETFs kind of like stocks. Like, you can buy and sell shares of VOO or SPY whenever you feel like it when the stock market is open. But with an index fund, you can't do that. With an index fund, there are limitations as to when you can actually buy an index fund. And with an index fund, there are also minimums of how much money you have to invest in order to buy an index fund. So index funds have more restrictions than ETFs do, but they work relatively similarly. I'm not going to go too deep into the differences between ETFs and index funds in this video, but I already made a video where I went over that. So if you want to watch that video, I will link it for you in the description below. Now, moving on to this side of the equation, you also have different types of stocks. Like, you have blue chip stocks, you have growth stocks, and REIT stocks. Blue chip stocks are your big massive corporations that everybody knows about. So McDonald's, Coca-Cola, Visa, these are your blue chip corporations. These are your big, large companies that everybody knows about. And these are the companies that people are investing in if they want a long-term, slow, stable growth because they believe in these companies. And for these companies to go bankrupt, it will be a pretty big deal. And so the whole idea is that by you investing in these big companies, yeah, you might not see massive growth, but you have slow, steady growth. And so you have less risk here as compared to something like a growth stock. Growth stocks are companies that are typically younger, and these are younger companies that are trying to grow as big as possible, as fast as possible. Many times these growth companies are not even profitable because they're taking every dollar that they earn and more through debt and other investments, and they're taking this money and they're throwing it back into the company. That way they can grow as big as possible, as fast as possible. So Uber, the ride sharing service, used to get a lot of heat here, because for years you would see these articles talking about how Uber is losing so much money, but they're getting this insane valuation. The reason they were losing so much money is because they were going into new markets, new countries, new cities, and they were spending so much money by giving people free incentives and free rides. That way they start using the Uber app instead of something like Lyft or another competitor, because Uber just wanted to expand their market share. So they were willing to lose money. That way they could just get users, because they understood that if they can get more users today, eventually these users will hopefully be profitable. And so companies like that are in the growth phase. They're just trying to get as much market share as possible and grow as fast as possible because they want to make money in the future. They're not profitable right now, but they're trying to make money in the future. Sometimes you'll see growth companies that are profitable today, but a lot of times they're investing a lot of money to grow as big as possible, as fast as possible. The advantage here is you can see a lot of growth with your stock price because this company can grow much bigger. I mean, you could see 20 to 200% growth in a company's revenue in a year with the growth stock. You're not going to see anything near that in a blue chip stock because these companies are just trying to get slow and steady growth because they're this massive behemoth companies. Here, these are the small, scrappy companies that are trying to go big. The risk here is because they're small and because they might not be making a lot of money and because they're investing so much money and taking on all this debt to grow, there's a chance that this company will fail. And if they fail, so does your investment. So you have the potential to make more money here, but you also have more risk to lose that money. REITs are real estate investment trusts, and this is a way for you to get exposure to real estate indirectly through the stock market. So when you invest in a REIT, what you're doing is you're investing in a company that invests in real estate. So you have REITs that invest in apartment complexes, and you have REITs that invest in shopping malls and a whole bunch of different things. But essentially what you're doing is now you're investing in this company that invests in real estate, and this company is making money from rent. The reason people like REITs in the stock market is because REITs are required to follow something called the 90% rule, which says that REITs have to pay out 90% of their taxable income, their profits, to the shareholders, people like you, through dividends. And so now, instead of you getting rent, you are getting these dividends from the company that you're investing in because they are required by law to send you your share of this 90% of the taxable income. So the reason people like REITs is because they give you that cash flow. But the disadvantage with REITs is you don't actually get exposure to the physical property. You're just investing in the company that invests in the property. Now, before you jump in and say that you're going to throw all of your money into growth stocks because you want the high risk, high potential reward, you also want to know what your goals are and how to buy stocks before you actually buy stocks. So there's a couple of different strategies when it comes to investing your money or trading your money in the stock market at a very high level. You have a short-term strategy and you have a long-term strategy. When we're talking about short-term trading, we're talking about investing in trading stocks rather for less than 1 year. So you're buying shares of a company and you're going to sell it within a year because you want to make money in the short term. Long-term strategies are 1 year or more. Sometimes when we're talking about long-term investing, we're talking about just a year, but typically we're talking about many years, if not decades, if not forever. Like Warren Buffett says that when he makes an investment, he wants to invest in this company forever. So long-term investing is literally investing for the long term. Short-term investing is investing for the short term. But the thing that you have to understand about short-term investing and long-term investing is the way you analyze a company is very different. Because when you're analyzing a company for short-term trading, the things that you're paying attention to are technicals. And what technicals are is stock charts. So if you've ever seen those candle charts before where they show these kind of crazy things happening in the stock chart, that's what traders are looking at. They're paying attention to these swings in the stock market because they're trying to find companies right before they make this upswing, and they want to buy here and sell it here. They want to make the quick buck, sell it, and then move on to the next stock. And so when you're looking at the short-term stocks, you're not typically paying too much attention to what a company's profitability is and how their profitability has been growing over the years, or their revenue growth, or their executive structure. You're just trying to find these quick swings. You're trying to find where the momentum is, and you're trying to make money quickly. When you're a long-term investor, it's a little bit different. Here, you're paying attention to the fundamentals. When you're looking at long-term investing, you want to understand the numbers. You want to see, are the revenues growing? Are the profits growing? Who runs the company? Are they a good manager, or are they going to run the company into the ground? How hard is it for another company to compete with the company you want to invest in? And are their profits going to continue to go up in the future, or are they releasing really crappy products? These are the things that you want to pay attention to for the long term, and the short-term swings really don't mean too much for you because you want to invest for the long term. If the stock price goes down more, you want to come in and just buy more. Here, you're just trying to make the money and leave. At this point, you might be thinking, why in the world would I want to wait years to make money when I can make the same money quickly? Well, short-term trading comes with more risks. Yes, you can make more money quickly, but this is what builds long-term wealth. You can make money here, throw that money here, that way you can compound and grow that wealth. But what you'll see is that over the long term investors always beat the short-term traders, but in the short term, you see sometimes short-term traders making huge profits depending on the market, because you can make a lot of money very quickly here, but if you want to make money for the long term, this is where that money is made. That's how people like Warren Buffett have made so much money over their lifetimes, because they focus here. And then sometimes you can see traders way outperform people like Warren Buffett, because some years you're going to see huge profit potentials here. So you can make money here, throw it here, that way you can compound and grow that wealth. But the way you actually buy stocks here and here is going to be a little bit different, because some stock brokerages cater to these people while other stock brokerages cater to these people. So you want to make sure that when you're actually buying stocks, you're using a brokerage that is going to align with your goals. I'm going to give you a couple examples of brokerages that you can use depending on if you want to be a long-term investor or a short-term investor. You're not required to just be one or the other. You can do both, but there are different brokerages that you want to use. Both of the brokerages that I'm going to talk about are sponsors of ours. You're not required to use them. You can do your own due diligence. If you want to find a different one, that's fine with me. I'm just giving you a couple examples of brokerages that I like. The first for long-term investing is M1 Finance. The reason I like M1 Finance is because it lets you invest passively and automatically for the long term. The way it works is you get to create a pie. That's what they call it. And so now every month or whatever you want, you can automatically have money withdrawn from your bank account, and it will be invested into your stock pie. And you can allocate what stocks, what funds, and how many of each do you want in your pie. So in this pie, you can have ETFs, you can have stocks, and so you can decide how much of each fund or stock you want to be in this pie. Like this could be 35% of your pie. This could be another 33% of your pie. This could be 20% of your pie, and on and on and on. And so now anytime $1,000 or whatever amount you want gets pulled out of your bank account, it will automatically be invested into your pie based off of the allocations that you set. The reason why I like this is because if you want to build wealth for the long term, you're not just going to invest some money today and forget about it, because now you can set up the schedule. So every month or whatever you want, money is going to get pulled out of your bank account. You can set however much money you want to be withdrawn, and this money is automatically going to be invested into the stocks and ETFs that you want. So you can just invest it and forget about it, and you don't have to do the work to invest. It automatically happens for you, and now you have your long-term investing happening, and you don't got to worry about accidentally spending this money because it's already in your investment account. So if you want to learn more and see how you can start investing for the long term with M1 Finance for free, I got the link to how you can do it in the description below. If you're interested in being a short-term trader, then you can look at a brokerage like Webull. Webull, one, does not charge you a commission to make a trade, and second, they're also giving Minority Mindset fans free stocks just for investing with them when you use our link below. But also, the cool thing about Webull is you get real-time market news, you can chat with other traders on their platform, and you can trade stocks, ETFs, and cryptocurrencies right on their platform. So Webull is cool because it lets you do a whole bunch of things. You can research stocks, you can chat with other people, and you get free stocks just because you are a Minority Mindset fan. So if you want to learn more about Webull, I got the link to how you can do that in the description below. This is where you have to know how to analyze your investment, because you want to know how you can find a good investment in the stock market. Now personally, I'm more of an investor than I am a a trader. And so I'm going to be focusing what I'm talking about in terms of finding a good investment on the investment side of things, not the trading side of things. The first thing that you have to understand, and one of the biggest mistakes that I see newer investors make, is that you should not analyze a stock based solely on a stock price. So I'll give you an example. Let's say you have company one that is currently trading for $125 a share, and you have company two, which is trading for right around $1,400 a share. Based off of this information, which company is a better investment, and which company is bigger, and which company is more expensive for you to invest in? Now, this is where a lot of people might say, here, this company is clearly more expensive because you have to pay more money for a share, and it's probably overpriced because it's so much money per share. But let's dive a little bit deeper, because what if I told you that this company is having a market capitalization or a valuation of $2 trillion, while this company has a market capitalization of just $40 billion. Now all of a sudden you can realize that you're buying these shares at a certain price for the entire company. So while the price for one individual share is smaller here than here you're buying a much smaller piece of the company because the entire company is valued at $2 trillion, versus here you're spending a lot more money for one share of the company, but you're getting a bigger chunk of the company because here the entire company is worth $40 billion. So this is a real example. This is, at the time we're recording this video, the Apple stock, and this is the Chipotle stock, CMG. And at the time we're recording this video, Apple's trading for right around $125 a share and is valued at right around $2 trillion, while Chipotle is trading at around $1,400 a share and is valued at around $40 billion. So you should never analyze a stock solely by its share price, because the share price is going to vary depending on how many shares are out there and what the valuation of the company is. Because Chipotle can come out and they could say, we're going to double the amount of shares out there. If they did that, well, now their stock price is going to be trading at $700 a share, now $1,400 a share, because now they just increased the amount of shares out there. So when you're doing your research, you got to look at way more than just what the share price is. Your job as an investor is to look at this and say, okay, Apple is valued at $2 trillion and Chipotle is valued at $40 billion. Which of these is a good valuation, or an expensive valuation, or an undervaluation? You have to do this research, and based off of what your research tells you, that's where you got to decide. Because if it's undervalued, then it might be a great opportunity for you to come in and invest in this company if you believe in this company for the long term. If it's a good valuation, this still might not be a bad investment opportunity, but if it's overvalued, then you might not want to pay unless that you believe that there's a lot of future potential with this company. So there's a lot of different things and research that you can do to decide if a company is overvalued or undervalued or good valued. And one of the things that you can look at, out of the many things that you should look at, is the PE ratio. PE stands for price to earnings ratio, and essentially what this tells you is how many times earnings a company is selling for. So one of the easiest ways to understand this is just think about Shark Tank. If somebody comes onto Shark Tank and they say, I have a company, a guacamole company, that I am valuing at $100,000, and this year I made a profit of $50,000, that means this company, my guacamole company, is selling for 2 times earnings. Because yeah, I made $50,000, but I'm valuing my company at $100,000, so I'm selling my company, or a share of my company, for 2 times the amount of money I made today. So you're selling for 2 times earnings. Here, in Apple's case, their PE ratio is 28. In Chipotle's case, at the time we're recording this video, it is 98. So now, if you look at this and this, you might say, whoa, Chipotle is way more expensive than Apple is, so Chipotle is overpriced. But again, you're not comparing apples to apples, because certain industries and certain sectors are going to have different types of PE ratios, and different companies, like growth companies versus blue chip companies, are also going to have different PE ratios. So you got to make sure you're comparing apples to apples, because certain sectors are going to have way higher PE ratios on average than other sectors, and certain types of companies, like growth companies versus blue chip companies, are going to also see different types of PE ratios. So if you're analyzing a stock based off of a PE ratio, you want to make sure you're comparing apples to apples and understand that this is just one indicator. You got to look at the company as a whole, and the way you do that now is you're going to dive a little bit deeper. You're going to look at a company's earnings reports. So every company that is public, meaning on the stock market, is required by law to release how much money they're making in revenue, what their expenses are, what their profits are, and they have to put all this information in a cash flow statement and a profit and loss statement, and you can get all this information on a company's website. So you can go onto the Apple website or the Chipotle website, scroll down to the Investor Relations tab, click it, and you are going to see their quarterly reports, meaning a report that they put out every 3 months, and their annual report will just show you how much money they made this year and this quarter, and they'll compare it to their previous years and previous quarters. So now you can analyze this information, see what their profits are, see what their revenues are, and see what their expenses are, and then decide if this is a good investment or not. Now you can see that if a company's expenses are growing, this might be concerning, but you want to pay attention to why are their expenses growing. If their expenses are growing because the cost of doing business is going up and they're making smaller profits, that might not be so good news. But if you see their expenses going up because they're investing so heavily into their company because they want to grow for the future, that might be good news because they're trying to make bigger profits in the future. The thing that makes this type of fundamental analysis tricky is that there's no secret sauce where you just look at X, Y, Z, and based off of this, this, and this is either a good investment or a bad investment. You have to look at the numbers. You got to look at the revenue, the profit, the expenses. You want to look at the cash flow, but you also want to kind of feel the company. How is the executive structure? Are these managers good? Are they going to grow the company or are they going to run it into the ground? Is this a good product? Do people care about this product? Are people still going to care about this product in 5 years or 10 years, or are they going to care about it way more or less? How hard is it for another company to come in and compete with this company? If it's very easy for another competitor to come in and kick this company out, that might not be a very good company. But if this company is very hard to compete with, then that's good for you. So these are the type of questions you want to be asking yourself as a long-term investor, because you got to pay attention to way more than just the numbers. You got to understand what the numbers are, how is the company doing, and how are they going to be doing in the future, because you as an investor are investing for the long term. So you want to see how innovative this company is and how smart this company is at staying with the times and really just making products that people love. Now we're finally getting into the fun stuff. How do you actually get paid? You put in all the work, you put in the research. Now how do you make the money? In the stock market, there are generally two ways that you can make money. You can make money through appreciation and you can make money through dividends. Appreciation is when the stock price that you bought goes up. So you bought a stock for $100 a share and this company made more money or people really like it, and now the stock price has gone up to $200 a share and you sell. If you do that, you bought a stock for $100 and you sold it for $200, the stock appreciated $100 a share and you just made $100, assuming you own just one share. If you own 2 shares, you made $200 because you made $100 per share. That's what appreciation is. Dividends, on the other hand, are cash flow payments that you get that you don't have to sell your stock for. So there are certain companies on the stock market that have so much cash in their bank account that at the end of the year, they don't know what to do with this cash. They already have their savings. They don't want to invest more money back into their company because they're already so big. And so what they do is they reward you, the shareholders, by just giving you this cash through dividends. The advantage here is you are getting regular cash flow and you don't have to sell your stocks to make any money. The disadvantage with dividends is now a company that is taking this cash and giving it out to you, shareholders, is not using this cash in the company. So that means that this company is probably really large, is really big, and they might not see that same upside and growth potential as some of the growth companies. Remember what we talked about earlier? Growth companies are companies that are taking all their profits, or a big chunk of their profits, and they're reinvesting it back into their company. That way they can grow as big as possible and as fast as possible. When a company is paying out dividends, that means they have so much profit that now they're not really worried about growing a whole lot bigger. They just want to keep rewarding the shareholders for investing with them. So when we're investing in dividend companies, chances are you're not going to see major stock price growth, but you're getting paid just for owning a stock. So you're getting paid just for owning the right companies, and you don't got to do anything. You don't got to sell your stock. You don't got to work for the company. You're just getting checks in the mail just because you own the right company. This is where it really pays to know what your goal is, because if your goal is to make the most money possible and you're willing to take on more risks, then you shouldn't be worried about dividend stocks. You should be worried about trying to get the most appreciation. Yes, there's more potential risk because you're not making any money right now. You're just hoping that this company is going to make you more money in the future, but you have the opportunity to see a lot of upside. If you want to just see consistent cash flow, that way you have money coming into your account every few months or every month, that way you have money to live off of, then you want to be looking at dividends. And you got to understand, the different kind of pros and cons that you get with dividends versus appreciation. And the last thing that you want to make sure you understand when we're talking about appreciation versus dividends is taxes, because these two things are going to be taxed differently, and I'm going to get to that in just a minute. So now moving along to number 6, you've been investing in a company, maybe you made a lot of money, maybe you're losing money, and you're trying to decide, is it time for you to sell? Is it time for you to cash in on your gains? or is it time for you to cut your losses? So let's talk about when you know if it's time for you to sell your stocks. If you are a trader and you're trying to make money in the short term, you have to know your sell parameters before you buy. You got to know that if the stock falls 10% or whatever your risk parameter is, you need to sell it no matter what. And if your stock goes up by X amount, let's say 50%, you've hit your sell target and now it's time for you to sell. So if you're a trader, you're going to have these parameters in before you even buy, and you got to know exactly when to sell if it goes down or if it goes up. If you are a long-term investor, it's a little bit trickier, because if the stock goes down and this company is still fundamentally very good, they're still making a lot of money, people just don't understand it, and so the stock is going down, you shouldn't be selling. At this point, you should just be coming in and buying more. In general, there are 4 reasons for why you should be selling your stock. The first reason is if there's a company failure. If you're investing in this company for the long term because you believe in the long-term value of this company, and then all of a sudden, this company starts sucking. They start releasing crappy products, their company executive structure goes to crap, or this company starts losing a lot of money, this company starts blowing their money away. If this company starts tanking, then that's a reason for you to sell, because you no longer believe in the long-term value of this company. So when you're investing in companies for the long term, you got to keep up with the company. You got to make sure that it keeps innovating, that it keeps growing, that it keeps releasing good products. If you start to see this company really declining, then that might be a reason for you to sell, even if the company's down. Because if a company's going down and it's starting to fail internally, then you want to sell before it goes bankrupt. However, if it's going down, but the company is still releasing great products, if it still has great fundamentals, then that's when you want to be coming in to buy. So if a stock price is going down, you got to know why it's going down. Is it because the company's failing, or is it because people don't understand the stock? If people don't understand the stock, you want to buy more. If the company's failing because the company sucks, you got to get out of it. The second reason why you would consider selling a stock is if you have better use for your money. Like if you're investing in a dividend stock that's paying you 3% a year, and now you found another investment. Let's say you find a rental property that's going to pay you 5% a year in consistent cash flow, and you have better upside potential, then yeah, you can sell out of this and move it to somewhere where you're going to get better returns. So same with appreciation. If you start making money with a company and then you find a company that you like more and you think this company has way more upside potential, then you could sell this and move this money here if you think you're going to make more money here. The third reason why you can sell is if you need the money. Let's say you're invested into a company and you start to make a lot of money and you've seen 100% returns over the years, but now you want to go out and you want to buy a home. Well, this could be an opportunity for you to sell if you have a use for this cash, if you need to buy the home. Now, this is where you want to make sure you're making smart investment decisions and that you're not selling all of your stocks to go out and go on a vacation or buy a car and buy a home. You want to make sure you have investments. But if you have big profits in some of your investments and you have other investments, you can sell some of these investments if you want to buy things, especially if you have a lot of money here, but you just got to make sure you're managing your money smartly when you do that. The last reason why you would consider selling is if you win. Meaning if you made enough money where you're satisfied. If you invest in a company and you see massive growth and you're like, yes, I invested in this company when it was undervalued. Now I have made a ton of money and this company is now overvalued. Well, now chances are you made a lot of money because you bought the stock when it was undervalued. Now it's overvalued and now you made a lot of money along the way. Now you can sell the stocks and now you can walk away because you have just won in this transaction because you believed in this company when nobody else did. So when it comes to selling your stock as a long-term investor, these are the main things that you want to understand. Now, before I get into taxes, if you are interested in learning more about the different strategies there are with stock market investing and stock market trading, and you want to go a little bit deeper into that part of the stock market, our team put together an amazing stock market PDF that walks you through what you need to know about trading and investing your money in the stock market. This PDF is completely free when you sign up for our daily newsletter, and I'll link it for you in the description below. All right, taxes. Like they say, nothing is certain in life except death and taxes. If you make money, well, now you got to pay taxes. But the amount of taxes you pay are going to change depending on how you made that money. The first thing that you got to understand about taxes is that the government and the IRS incentivize you to be a long-term investor, because if you are a long-term investor and you make profits, you get tax breaks. Versus if you are a short-term investor and you make profits, well, now a short-term trader and you make profits, you don't get those same investment tax breaks. So if you are a long-term investor and you invest your money for longer than a year and you sell it for a profit, you get something called long-term capital gains rates, and these are much lower tax rates than your ordinary income tax rates. Like when you go to work and you get paid, that's considered your ordinary income tax rates, and these are the tax rates that you have to pay if you are a short-term trader, because the IRS and the government look at you as if this trading is your job, and so they're going to tax you accordingly. And so because you're working actively to trade your money, they're going to charge you higher taxes as if you made this money from a job. Now, why is job income taxed differently than your long-term investment income? Well, that's a conversation between you and the government. The next thing that I want you to understand about taxes are dividends, because dividends, most dividends, are qualified dividends. And what qualified dividends are dividends that qualify for these long-term capital gains rates, meaning these lower tax rates. Now, this is good news for you because you get to pay less taxes on your income through dividends. But the thing that you have to understand about dividends is when you get these dividends, you have to pay taxes on it. Even if you take this dividend income and you reinvest it back into the company, you still have to pay taxes on this income that you received, even though this money is not in your bank account. Because sometimes you can make $5,000 or $20,000 a year in dividend income, and you can reinvest all this money back into the company. But if this money is not in your bank account, you still have to pay taxes on it. And so now you're gonna have to pull out this cash from somewhere else to pay taxes on this dividend income, even though you reinvested all this money back into the company. That's the last thing that I wanted you to understand about comparing appreciation versus dividends, because when you're looking at appreciation, especially when you're talking about companies and growth companies, that means these companies are losing money. They're taking all of their profits and they're reinvesting it back into the company, and they're going into debt or doing other things to raise money to keep investing back into the company. That way they can grow as big as possible, as fast as possible. Here, you're going to see price growth in the stock, assuming they continue to grow. But you don't have to pay any taxes on this price growth because you don't actually pay taxes until you sell the stock, because you're not making any money until you sell. With dividends, on the other hand, you're paying taxes year after year after year when you're getting dividends because this money is coming into your pocket. And so that's just one of the other things that you want to understand, is that with appreciation stocks, especially these growth stocks that are trying to grow quickly, you don't got to pay taxes on this growth until you actually sell it, assuming that the stock price goes up, versus with dividends, you got to pay taxes anytime you make money, even if you reinvest this money. Now, before we get into the next clip, I do want to let you know that if you are interested in learning more about money management and investing, our team has put together an amazing guide that will walk you through the things you need to know about managing your money and starting to invest your money the right way. That way you can build your wealth. This guide is completely free when you sign up for our daily newsletter. So if you want to download this free guide and start reading our daily newsletter, I got the link to how you can download it for free in the description below. There are 5 ways for you to generate cash flow. You have to use your money to buy one of these 5 things. Number 1 is to generate interest cash flow. The way it works is you take your money and now you lend this out to someone else. So you take $1,000, you lend it out to your cousin Bunty. Now your cousin Bunty goes to his favorite store, Gucci probably, and now he's gonna go buy himself a new wardrobe, and he's gonna pay you interest on the $1,000 that he borrowed from you. Number 2 is royalty cash flow. Royalties are when you go out and you write a book, and now if this book gets published and it is kind of being read by a lot of people, now you're gonna get royalties every time somebody buys your book. Profit share is now kind of like Shark Tank. You go out and you find a nice company and you give them some of your money. Now this company starts to grow, and every time this company makes a profit and they distribute it to their owners, you get your share of the profit. So if you own 10% of a company and they make $100,000 profit and they distribute this $100,000, you get $10,000 as the profit share distribution. Number 4 is rent. I love talking about real estate investing. This is where you buy a property, and every single month a tenant that's living in your property is going to pay you rent for living there. And then number 5 is dividends. This is purely passive. Now you can invest in a company or a fund that is going to pay you cash flow through dividends, usually every quarter. These top 4 are kind of passive. They can be passive, but they require some sort of work. Like with interest, if you want to lend your money out, yeah, you don't have to really do any work after you lend your money out, but it takes a lot of work to find somebody to lend your money out, and you have to qualify them and make sure that you get paid. If you don't get paid, now it's more work on your end. Royalties. If you want to get the royalties from selling a book, you got to write the book first, so it requires work. Profit share. Now, if you want to be a venture capitalist or a shark on Shark Tank like that, it takes a lot of work to analyze the companies, and you got to help them grow, so it requires work. Rental income. Yes, real estate can be a passive investment, but now you got to put in the work to find the property. You got to build the real estate team, and you got to do all that work. Dividend cash flow is purely passive. Once you find the right company or the fund that you want to invest in, this money is going to come in and you don't got to do any work, which is why in this video, we're going to be focusing here. how you can live a dividend lifestyle, meaning use the cash flow from dividends to fund your life. So that's what we're going to be talking about today. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below. And a quick word from our sponsor, M1 Finance. If you are interested in investing your money, M1 Finance lets you do it automatically and passively. So if you want to learn more and see how you can do it with M1 Finance, I got the link to how you can do that in the description below. So if you want this cash flow from your investments, this passive income to cover your investments, you got to know what it's going to take. And let's assume, for the sake of this example, that you want $40,000 a year to cover your expenses. $40,000 a year is just over $3,300 a month. So you want to make $3,300 a month in cash flow from your investments. Now we've got to figure out how to do that through dividends. Essentially what you got to do is you got to understand the different types of income there are. So there's active income and then there is passive income. What you're going to do is you go to work every single day. And this is the active income that you're earning. This is your earned income. You go to work, you get a paycheck, you want to take some of this money and you want to put it towards your passive income, towards your passive investments, things that are going to pay you with cash flow. In this case, we're talking about dividends. So every time you get paid, you want to put a little bit of your paycheck, the more the better, towards your passive income. And now in this video, I'm going to be going over how and how much to get this $40,000 a year or $3,300 a month. That way now your dividend income can fund your actual lifestyle. The way dividends work, and I'm going to get more into this in just a minute, but you can take your money and you can invest it into a company like McDonald's. Now, McDonald's is a very established company and every year they have a whole bunch of profit, a bunch of cash sitting in their bank account. Now, when they have this cash in their bank account, there's three things they can do with this cash. They can save some of this cash for emergencies, they can put this cash back into their business so they can grow faster, or they can give this cash back to their investors, people like you. So what they do in this case is they say, well, we have so much cash in our bank account that we have no better use for this cash in our own company, so we're just gonna give it away to our shareholders in the form of a dividend. So every year, or actually 3 times a year, McDonald's sends out a check to all the shareholders, people like you, people who own their stock, and this is what a dividend is. So a dividend in this case is every 3 months you get cash deposited into your bank account because McDonald's has paid you a dividend. It's completely passive. You don't have to do any work to flip burgers or any of that. If you own the right shares, now these companies will pay you with this cash flow. The reason why dividend investing can be so attractive to some people is because you don't need a ton of money to start investing in dividend stocks. Like you can start investing in dividend stocks for as little as $100. You can compare that to investing in real estate where you're not going to buy a property for $100. So if you want to start investing in dividend stocks, start generating this cash flow from dividends, it's a much lower barrier to entry. You can start with $100 a month or whatever money you have, and you can slowly let this compound. And at the same time, if you invest in a strong company, hopefully the stock price will go up. And as the stock price goes up, hopefully the dividends will go up too, because as a company makes more money and their profits grow, they'll be able to send out bigger checks to you. So if you invest in the right companies, you can win in a few different ways because you'll get bigger cash flow every single year. And the value of your stock, your investment, is also going up. Now, if you really want to understand what it would take to replace your income, in this case, assuming $40,000 a year with dividends, you got to understand what kind of dividends are out there. Now, I do got to give you a little bit of a disclaimer here because investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So you should always do your own due diligence and never blindly listen to a random guy on YouTube. And everything I'm talking about today are just examples. I'm not telling you what to invest in. I'm just showing you how the process works. So you want to always do your own due diligence, okay? Right now, at the time of me recording this video, McDonald's is paying a 2.3 annual dividend yield. Now, this can change with time, but this is what it is right now. If you wanted to invest money into McDonald's right now and make $40,000 a year in dividend income based off of this dividend rate, you would have to invest $1.7 million in order to get $40,000 a year in passive cash flow through dividends in McDonald's. Now, I know this is going to seem like a lot of money, but I'm going to show you how you can accelerate this. EIX, this is Edison International, the electricity company. They pay out right now at the time we're recording this video a 4.5% dividend yield. So if you wanted to get the same $40,000 a year in passive income through EIX, you would have to invest right around $888,000 into this company today based off of this 4.5% yield to generate $40,000 a year passively. If you wanted to do it through IBM, which is right now at the time of recording this video, paying a 4.8% yield, it's going to cost you $833,000. And AT&T right now is paying a 6.9% yield. And if you wanted to get the $40,000 a year, it will cost you right around $580,000 today. Now, there's a couple things that I want to point out with this. One, this is not something that you have to just do today. If you want to build this cash flow, this dividend income, it's going to take time. And the way you want to do this is by every single month, every time you get paid, you want to put some money towards your investments. And the best way to do that is automatically, that way you don't accidentally forget to do it. But you want to consistently keep investing your money into these stocks or whatever dividend stocks you're looking at if your goal is cash flow, because now what you're doing is every month you're just building up this machine that's paying you. Maybe right now you're only making $5 a month, but over time that's going to grow to $50 a month, then $500 a month. And so you got to understand that this dividend cash flow isn't something that just happens overnight. It's something that takes time. It's something you got to build up. So you got to get into the habit of understanding that every time you get paid, some of this money has got to go into your cash flow producing machine, your dividend stocks that are going to pay you with income. The second thing that I need you to understand is the risk. Because let's just say, for the sake of this example, that you look here at AT&T and you say, AT&T is paying the highest dividend, so I'm going to invest my money only into that company. And so now for the next 10 years, you keep investing some money into AT&T, but then AT&T goes bankrupt. If that happens, now all of this money that you put into it would disappear because this company just went down the drain. And now this wasn't your fault. It was the executives at AT&T that ran the company into the ground because you were just hoping to build this money printing machine. But the executives at AT&T didn't do a good job, so now you have to pay the price. So you got to understand that there is risk here. When you invest in individual stocks, you take on all the risk. So there are ways for you to mitigate that risk. Number one is by doing your research. If you want to invest in individual stocks, you have to keep up to date with the company. You have to read the earnings calls. You have to read the financial statements. You got to see how this company is doing. Because if you start looking at a company and you see the revenue starting to drop, you see the profit starting to drop, you see people not liking this company so much, then that's a red flag that you want to pay attention to. But if you don't want to really do all the work, then you shouldn't be investing in individual companies, individual stocks. Then what you want to be doing is investing in funds that give you exposure to dividend paying stocks, because there's something called ETFs, which stands for exchange traded funds, which give you exposure to a whole basket of stocks. So now instead of you trying to find the best companies to invest in, you can invest in an ETF, which gives you exposure to a whole bunch of dividend paying stocks. That way now, if one company goes bankrupt, you're okay. There's a whole bunch of other companies in there that are still paying you with cash flow, with dividends. So if one company goes down, you don't lose everything. So let's take a look at some ETFs. What you want to understand here is that not all ETFs are made equal. So when you're looking at ETFs, the way you do your research here is you can just research any ETF you want on Google, and it's going to pull up kind of like a fact sheet about the ETF, and it will tell you which stocks are in the ETF. So you want to kind of just get an idea of which companies are in there, because although you're not going to be doing the research on every single company and reading all the earnings statements, you want to kind of get an idea or a sense of what types of companies are in there. I'm not going to be going over how to actually invest your money in this video, so if you do want to learn more about how to do that and how stock market investing works, you can read our free PDF on stock market investing. It's a great guide that our team wrote that'll walk you through what stock market investing is, how it works, and how you can start successfully investing your money in the stock market. If you want to read that guide, it's completely free when you sign up for our newsletter, and I'll link it for you in the description below. So if you're looking for cash flow and you invest your money into SDIV, which is a high dividend ETF, then this right now at the time of recording this video is a 7.25% annual yield, which means you would have to invest right around $530,000 today in order to get this $40,000 a year passively. If you invest your money into VYM, which is a Vanguard ETF for dividend stocks, this pays right now at the time of recording this video a 3% yield, which means you would have to invest right around $1.3 million today in order to get the $40,000 a year. The same concept applies here to ETFs as it does stocks. This is not something where you're just gonna write a one-time check today. If you really want to do this the right way, this is where you're gonna want to have your money going into your investments every single month or every time you get paid. That way you can build this machine over time that is constantly paying you. And if you invest your money into a good machine, good stocks, good ETFs, then not only is your machine going to become more valuable, but your machine is going to be printing more money because the companies in your machine are making more profits, so they're paying out bigger dividends. A third very common way to invest your money for this passive cash flow dividends is by investing your money in REITs. A REIT is a real estate investment trust, and technically a REIT is a stock, But people look at stocks and REITs a little bit differently just because stocks give you exposure to companies like McDonald's and AT&T and IBM. REITs give you exposure to real estate. So a real estate investment trust is a company that invests in real estate, and they kind of get their own kind of special classification within the stock market, because when you invest in a REIT, you are pretty much investing just for cash flow, because the way REITs work is they have a 90% rule, which says that REITs are required by law to pay out 90% of their profits to their shareholders, people like you, through dividends. And so REITs make money through rent, and they have to pay 90% of the profits out back to you through dividends. So REITs pay out a whole lot higher dividends just because the whole point is to get this income through rent and then pay it out to you. The advantage for you to invest in REITs is you don't have to deal with all the headache of trying to find the right properties, dealing with contractors, dealing with tenants, dealing with property managers. You're just investing your money into the company that manages and owns the real estate. A couple examples of REIT ETFs that give you exposure to a basket full of different REITs. Again, I'm not telling you what to invest in, just examples are SCHH. This is the Schwab REIT ETF. And then VNQ, this is the Vanguard REIT ETF. When I say Schwab and Vanguard, these are just different companies that create and manage these ETFs. If you're not sure what I'm talking about, I already made a video where I explain what Vanguard is and what Vanguard funds are. That video will explain all of that. So if you want to watch that, I'll link that video for you in the description below. But SCHH right now at the time of recording this video is paying 2.8% a year, which means you'd have to pay right around $1.4 million today in order to get this $40,000 a year. And with VNQ, you would have to invest right around $1 million today in order to get this $40,000 a year passively. If your goal is purely just cash flow, at this point you might be thinking, all right, well, if I'm just trying to make as much cash flow as possible, I should be looking for funds and stocks that pay off the highest yields. And you might be thinking, okay, stocks are a little bit risky because I don't know or don't want to do all that research, then I'll just put my money into an ETF that's paying the highest yield. The thing that you want to pay attention to is that you never want to make an investment decision solely based off of this yield right here, because this yield can be deceiving. This yield is based off of the current share price, the current stock price that a stock is trading at. And so if a stock is tanking, then artificially a dividend yield can look so much higher because the stock price is down and the dividend might not have changed yet. And so you might buy into a stock or ETF thinking that you're getting this amazing yield, but what could happen is this ETF or this stock is on the verge of failure, which is why your yield looks so high. So you never want to look and make your decision just based off of what the yield is. That's one factor that you can pay attention to. But you really want to look at the underlying fundamentals. What companies are in the ETF? How strong are these companies? What sectors are they in? Are these strong companies that will be around in the future? Same with stocks. You're going to have to do a lot more research and kind of upkeep here, because if you're investing in one stock or a couple of stocks for the long term, you want to make sure that these stocks are continuing to perform and continuing to grow. With an ETF, you really just want to kind of get an idea of the company that is managing this ETF. Like Vanguard is one of the most reputable companies out there when it comes to ETFs, because they were like the pioneers of index funds. And so you just kind of got to get an understanding of who is managing your money or what companies are you investing in, because you want to make sure that this company or this fund that you're investing in is going to be around for a long time and it's going to continue to pay you for a long time in the future. Now, when you're investing for cash flow, you got to understand the drawbacks, because when you're investing in one of these companies, these are big established companies. And the reason why they're paying out a dividend to you is because they have so much money in their account that they don't know what to do with it. So the best use of this money is just to pay it out to you, the shareholder. You can compare that to a startup company, where this company, a startup company, might be using all of their money and more to grow as big as possible, as fast as possible. Like you might have heard that Uber was losing money for so many years. They were not profitable. Why? Because they were spending every penny that they had to grow quickly. And so not only were they spending all of their money, they were also losing money because they kept raising more money, getting into more debt. That way they can use this money to grow bigger. That way their company would become more valuable. So a company like Uber could see the stock price grow very quickly. I mean, they could see a 20%, a 50%, a 100% growth in revenue, and it really wouldn't be too surprising because they're a startup company and they're trying to grow very quickly. And so they're trying to see their stock price explode. You can compare that to something like McDonald's, where you're not going to see 100% growth in the revenue like that, because this company is not in that same ballpark. McDonald's is very big. They're very established. They're just trying to slowly keep growing their stores and keep growing their income slowly. That way they can just kind of maintain their dividends and maintain their growth. So this is where you kind of really got to understand what your goals are, because dividend companies are not going to give you that massive growth versus a startup company could. But at the flip side, a startup company also has more risk. A startup company could fail. It could go bankrupt. I mean, there's a lot of risks with investing in a startup company. With these companies, you have less risk. I mean, they can still fail. There's less risk, but you're not going to see the massive boom in the stock price that you could see with a startup company. I mean, over the long term, yes, you want to see the stock price go up, but your goal here is just that consistent cash flow. So you want to keep that in mind. The second thing that you want to make sure you understand are taxes, because now when you make this dividend income, it's taxable. The IRS is always going to want to get their cut when you make money. The way I want you to think of it is like a machine printing money. And the way that you can get more machines printing money is by using more money to buy more machines. So you have this one machine that's printing you money. And anytime it prints you money, you take this money and use it to buy another money printing machine. Now you have this machine printing you money, and when it makes you money, you use this money to buy another money printing machine. And now this money printing machine is also making you money. So now the first money printing machine is making you money, the second money printing machine is making you money, and you take all this cash and you use it to buy a third money printing machine, and on and on and on. This is what compounding is. And this is what they call DRIP, D-R-I-P, in a lot of stock brokerages, where you're now reinvesting your dividends automatically. The thing that you have to understand here is, yeah, you can take all of your dividends and reinvest it, which is good. It's a way for you to grow and accelerate your cash flow, because now not only are you putting more money into your investments every single month, but you're also using your profits from your investments every time you get paid to buy more shares. That way you're really just kind of building a big machine that's going to keep producing you more money year after year after year. But the thing that you have to remember here is, even if you don't take any of these dividends out and put them into your bank account or use them, you're still going to have to pay taxes on these dividends. So even if you reinvest all of your dividends, you're still going to have to pay taxes on the dividends that you received, even if you never use the dividends in your own personal account. Now, this is assuming that you're investing in dividends in your own personal account. If you're investing in dividend stocks through an 401k or an IRA or one of those tax deferred accounts, then you don't necessarily have to pay taxes on those dividends depending on what your account is. But if you're investing in your own personal account, then you're going to have to pay taxes on your dividends, even if you reinvest all of your dividends. Now, that's not a bad thing. I don't want you to stop investing your money or reinvesting your money because you're going to have to pay taxes on your profits. It's just something I want you to be aware of. So if your goal is to build up this machine that's paying you with cash flow, that way you can live off your dividend income, what you got to do is first figure out what you want to invest in, stocks or ETFs, or which kind of basket of stocks and ETFs. Second, anytime you get paid now, you're going to take a portion of your paycheck and automatically invest it into the stock or ETF that you want. Third, now when you get paid through your dividends, you want to reinvest these dividends back into your stock or ETFs. That way your dividends are building you more machines that are producing you more cash flow. Now, not only are you investing more money every single month, but your money that you're making is also going back into your machines to buy you more stocks and more ETFs. And fourth, you just got to remember that you're going to have to pay taxes on the dividends that you made, even if you don't get to put them in your own personal bank account today. If you do this, you're going to be building up a machine that's going to be building up your cash flow. And yeah, it's going to start small, but over time, you're going to start to see this dividend machine grow faster and faster and faster, because you'll have more money going into your dividend accounts, and your dividend accounts are going to keep producing more money, which is going to go back into them, buying you more shares that are paying you with dividends. When I invest my money, there's two things that I always look for. I look at how much risk is involved, and I look at how much money I can potentially make. If I was gonna invest $10,000 and I had to decide between investing this $10,000 into my broke cousin Bunty, who's on his 34th business idea, or investing this money into Amazon, who's established and has a business plan and is very successful, I'm gonna expect very different returns to justify my investment. Bunty is a risky investment, so I'm gonna need bigger potential returns to justify me giving him my cash, because as soon as I give him that $10,000, there's a good chance that he's going to invest that money into a new Gucci wardrobe. I gotta look good for the business. Deciding between investing your money in my cousin Bunty or Amazon is pretty obvious. I'm going to invest my money in Bunty. But what if you had to decide between investing your money between Amazon and Apple and FedEx and Verizon and McDonald's and Microsoft? who's gonna give you the best return for your risk now? Not so easy anymore. There's 3 different ways that you can take this. Option 1 is you can spend all the time researching these companies, and you might decide that Apple is the best company to invest in based off of all your research, and now you invest all your money into Apple. This one has the most risk because now if Apple releases a really bad iPhone and people start hating Apple products and their company tanks, well, down with it goes your money. It also comes with the most upside because now if you're right and Amazon wins big, then you're gonna win big. Option 2 is now you can open up a stock brokerage, and instead of just investing in one company like Apple, you can invest in every one of these companies. That way you're lowering your risk. If you do want to learn more about how to actually open up a stock brokerage and invest your money in stocks, our team wrote an article on our website, theminoritymindset.com, that walks you through how to do that. So if you want to read that article, I'll link it for you in the description below. This one requires more work because now you're not just managing and monitoring one stock, you gotta manage and monitor a whole portfolio of your stocks. Or option 3 is you can pay a small fee and then you can invest in a fund like a mutual fund or an index fund or an ETF and let these funds invest in all these companies for you. So now instead of you going out and investing in all these companies, you invest in a fund that gives you exposure to all these companies. Well, all 3 of these funds give you exposure to the stock market. They work in very different ways which can affect how much money you make, which is why you want to understand the differences. And that's what I'm going to be going over in this video as soon as you fund that thumbs up button below. Let's start with mutual funds. Mutual funds are known as actively managed funds. And to understand how they work, let's assume for the sake of this example that this is a mutual fund that's made up of only 4 stocks. A lot of times mutual funds will have way more stocks, sometimes hundreds of stocks, but just to keep things simple, we're going to assume that this mutual fund only has 4 stocks. If you wanted to invest in McDonald's, Tesla, Apple, and Amazon, one thing that you could do is you could go out, open a stock brokerage, and individually invest in McDonald's, Tesla, Apple, and Amazon. But now you have to decide how much of your money are you going to allocate towards each stock and what stocks do you want to own. On the flip side, when you invest in a mutual fund, you have this person right here. We're going to call this person a money manager, and we're going to draw him a nice mustache. This money manager is who you're trusting. So you're going to give your money to this money manager, and this money manager is going to create this fund. So this person is managing this fund, and when this money manager likes a stock, they're going to buy it. When they don't like a stock, they will sell it. So maybe right now this money manager likes these 4 stocks, but some time goes by and he's like, you know what? I don't like McDonald's anymore. We're going to replace them with Chipotle. So now he's monitoring the stocks and he's actively buying and selling based off of what he thinks is going on in the market and based off of what he thinks is going to make this fund more money. The whole point of a mutual fund is to have a really smart money manager with the goal of this money manager being able to beat the general stock market. So you are hoping that by paying this money manager a fee, you are going to be able to outperform the stock market, which in turn will make you more money. You're also getting the benefit of passiveness because now you're not having to go out and individually invest in all of these companies and manage each one of these companies. You have a money manager who's going to do that, and you also have the benefit of diversity because now this money manager is diversifying your money into different companies. If you want to invest your money into a mutual fund like this, you can expect this to cost you something like 2% a year on all of your assets. What that means is if you deposit $100 into your mutual fund, this money manager is going to take $2 a year to manage your $100. So if you invest $1,000, that's $20 in fees, and if you invest $100,000, that's $2,000 a year in fees. Now, while 2% might not sound like a lot of money, it does add up, especially as your money grows and compounds. Like if you started investing $500 a month today and you were paying 2% a year in fees, and you were able to get an average 7% return on your money, over the next 30 years, you're going to end up paying something like $166,000 in fees to your money manager just to invest your money. Now, look, I'm a value person. If you can make me an extra $1,000, I will gladly pay you an extra 2% in fees. So if you can make me more money, I will pay you more money as long as I continue to come on top. The only issue with this is what we've seen over the long term is these mutual funds don't always outperform the market. Actually, a lot of mutual funds can't even meet the returns of the general stock market over the long term. Like Warren Buffett was so confident in this that he made a $1 million bet that the general stock market, the S&P 500, would be able to outperform a number of hedge funds. These are highly sophisticated, highly expensive hedge funds. And over a course of 10 years, the hedge funds did well, but they did not even meet the stock market returns. So then the hedge fund owner had to then pay Warren Buffett $1 million because he lost the bet, and Warren Buffett took that $1 million and he donated it to charity. I'm going to go over how you can get the general returns of the stock market without paying these high fees, but in general, a mutual fund's goal is to be able to beat the market. That's why you're paying these fees to a money manager. That way you have somebody who can hopefully beat the market. The only problem with that is a lot of times you will not beat the market. Sometimes you will, sometimes you won't. It's really hard to predict because it's hard to beat the market, especially over the long term. This is not to say that mutual funds are never the right answer. I mean, there are some really good mutual funds out there, but a lot of these really good mutual funds are reserved for super high net worth people. Like, you need at least $500,000 to get into some of these mutual funds, versus some of the regular mutual funds that you're just paying 2% on. You can get a better return without paying all the fees. Second, let's talk about index funds. So the whole idea of index funds came about by this company called Vanguard, and Vanguard said, you know, what if we could let people invest in a group of funds like this without paying these super high fees? Well, the only issue with that is you need to pay this money to a money manager. So if Vanguard wanted to create this index fund where you can invest in a fund without paying all these fees, they also had to get rid of this person with a mustache right here. And instead what they did was they replaced that person with a mustache with a computer who automates this investments. Now you're investing in a fund, a group of companies, but instead of having a money manager decide which companies are in this fund, you're going to have a computer decide. So you create an algorithm. What are the type of companies you want to invest in? You punch that into the computer, and then the computer decides what company fits that fund. For example, I just talked about investing in a fund that gives you exposure to the S&P 500. The S&P 500 is an index, meaning it's a group of stocks that gives you exposure to the top 500 companies in the stock market. Now, one thing you can do is go out and individually invest in all 500 of these companies, but that's going to take a lot of work and a lot of management headache. Or you can invest in an index fund that gives you exposure to all 500 of these companies. That's what Vanguard allowed you to do. Now you can just invest in this index fund, and that gives you exposure to these top 500 companies. So now you're getting exposure to the general stock market without paying all the fees. VFIAX is the Vanguard index fund that gives you exposure to the general stock market. So Vanguard is the company that created this index fund. There's a bunch of banks and a bunch of companies that create these type of things. Vanguard is just one of those companies. It was the first to create index fund. So Vanguard has this index fund, which is a group of stocks that gives you exposure to the top 500 companies. If you want to know how much fees these index funds cost, all you got to do is search it on Google. So like with this VFIAX, you can see it says in the title that this is the Vanguard 500 Index Fund Admiral Shares. It has the word index fund in the title, so you know it's an index fund. And over here, you can see something called the expense ratio. This expense ratio is how much money you're going to be paying in fees. That's what you want to pay attention to. 0.04% in fees means that for every $100 you invest, you're going to be paying 4 pennies in fees. Compare that to the 2% fee you'd have to pay with a mutual fund, where you're paying $2 out of every $100 you invest. So the fees with an index fund are way less, because now you substituted that money manager with a computer, and computers are a lot cheaper to maintain than people, especially if they have a mustache. What you have to understand about index funds is a lot of them have a minimum investment. Like this Vanguard index fund has a minimum investment of $3,000. So if you don't have $3,000 to invest, you cannot invest in this index fund. And you also can't just buy and sell this index fund whenever you like. Index funds like VFIAX only let you buy and sell this index once a day. So if you're trying to trade index funds and mutual funds, that's not the way to go, because you can't just buy and sell an index fund whenever you want. You can only do that one time in the day, and typically it happens at 4 p.m. as soon as the market closes. But if you're looking to be a long-term investor, it really shouldn't matter too much, because now you're looking to invest for the long term. You're not looking to invest for 2 hours. And so what happens now is you're not going to see people trading these index funds every single day, because you just can't do that. The alternative to investing in an index fund like this is investing into an ETF, which stands for an exchange traded fund, because ETFs that you buy and sell these funds kind of like stocks. You can buy and sell these ETFs whenever you want, and some index funds have ETF versions of them too. Like if we go back to the Vanguard website, you'll see that this index fund also has an ETF version. It says it right below the title, also available in an ETF. If you click that button, it will take you to the ETF version of this index fund, which is VOO. VOO is an ETF that gives you exposure to the S&P 500, so the top 500 companies in the stock market, and this has an expense ratio of 0.03%. You can find this the same way you find the expense ratio of an index fund. Just search it on Google, and on this website, it will tell you what its expense ratio is. That's how much money you have to pay in fees every single year. So here, if you invest $100, you're going to be paying 3 cents a year in fees, so almost nothing. nothing. But unlike an index fund, you can buy and sell shares of VOO every single day whenever you want when the market is open. Remember, with the Vanguard Index Fund, you had a $3,000 minimum investment, and those transactions only happen once a day. With VOO, you don't have a minimum investment. All you have to do is buy one share of this ticker symbol, and then you can buy or sell VOO whenever you want throughout the day. So between this Vanguard ETF that gives you exposure to the S&P 500 and the Vanguard Index Fund that gives you exposure to the S&P 500, they both charge you essentially the same fees. They both invest in the same companies. The difference is VOO, you can see the real-time price throughout the day, versus the index fund you cannot. VOO does not have a minimum amount of money you have to invest versus the index fund you do. However, the index fund allows you to automatically invest or withdraw your money versus this ETF does not. So if you invest your money through Vanguard, you can automatically reinvest more money every single month through Vanguard versus with this ETF, you cannot do that. So if you're looking for a passive way to invest your money, that index fund gives you the benefit because now your money can automatically be invested every single month without you having to do anything, versus you can't do that with an ETF unless you're using a brokerage that can passively invest your money for you. The whole reason for you to invest your money into these passive investments is to see your money passively grow and compound over time. But if you want to see your money really compound quickly, you got to keep adding money to your investments. And the simplest way to do that is every single month, just add more money into this fund. So if you invest your money into the index fund, that can automatically happen. You can't do that with this unless you use a brokerage that automatically pulls money out of your savings account or your checking account, and they invest this money into your fund. If you want to learn more about how to do that, our team put together an article that breaks down the basics of investing, and I'll link it for you in the description below. So ETFs work almost the exact same way that stocks do, because you can buy or sell shares of an ETF the same way you do a stock. You can see the real-time price of an ETF the same way you can do a stock, and you don't have a minimum investment you have to invest minus the share price the same way you do a stock. Index funds, on the other hand, can give you exposure to all the same companies, and they let you do the automatic investing too. When it comes to your money actually being invested in an ETF or an index fund, there's an algorithm that tells the computer which company should be in your fund. So if you're investing in this ETF or in this index fund that gives you exposure to the top 500 companies, now what this algorithm is going to look at is which companies are in the S&P 500. If one of the companies in here, so let's assume Tesla for the sake of this example, tanks, and Tesla stops making money and their market cap decreases, then what this index fund will do is say, okay, Tesla is no longer in the S&P 500. They're no longer one of the top 500 companies or the biggest 500 companies. So they're going to kick Tesla out, and they're going to put in whatever the new company is that replaces Tesla. So it happens passively. You don't have to do anything. This happens in your index fund for you. And because this is happening through an algorithm, through a computer, you get to pay way less fees. So between mutual funds, index funds, and ETFs, which one can make you the most money? Well, before I say that, let me just remind you that investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. In general, for the majority of people, there's always going to be outliers and exceptions to the rule, but for the majority of people in general, index funds and ETFs are going to be the better way to go, because now you're going to meet the stock market returns and you don't have to pay the super high fees. Now, obviously, there are some mutual funds that are going to do great. There are some mutual funds that are going to greatly outperform the market, but there's a chance that you might not get that mutual fund. There's a chance you're going to pay the high mutual fund fees without even getting the market returns. So if you believe in the American economy, then you're going to believe in the American stock market, which means over the long run, the stock market will continue to go up. And if that's the case, then you can just get the consistent returns of the stock market by investing your money in the general stock market, by investing in an ETF or an index fund that gives you exposure to the general stock market. Between an ETF and an index fund, this is really personal preference. Do you want to have the automatic reinvestment into an index fund, or do you want to just invest your money into a brokerage that can automatically invest your money for you? Personally, I like ETFs because I like the freedom that comes with them. The key to succeeding with any of these is really just consistently investing your money month after month after month and keeping your money in the market for long enough. History has showed us that the stock market and the economy always goes up. That doesn't mean it'll always go straight up. Sometimes it will come down, sometimes it will crash, and sometimes it will correct, but over the long run, it will continue to go up as long as the economy keeps growing. So if you believe in the American economy, then this is a way for you to get that upside without actually starting your own company. crowdfunded real estate is when you and a bunch of other people invest your money into a fund that gives you exposure to a handful of real estate properties. You cannot invest in crowdfunded real estate on the stock market. You have to typically use a crowdfunding service, and once you invest your money into a crowdfunded real estate fund, you're not going to get your money back typically for years. A REIT is a real estate investment trust, and this is where you are investing into a company that's investing into real estate investment properties. Unlike crowdfunded investments, you can invest in REITs on the stock market, so you can buy and sell REITs whenever you want. If you're subscribed to this channel, you know that I love investing in real estate. If you're not subscribed to a channel, you should probably do that, but I invest in rental properties, I have invested in crowdfunded real estate and REITs, and all of these real estate investment options have their own pros and cons. This video is all about investing in REITs. Now, while I'm not going to go over crowdfunded deals in this video, if you do want to learn more about crowdfunded real estate, I have an article on our website where our team goes over everything you need to know about investing in crowdfunded real estate deals. And if you want to read this article, you can do it on our blog by clicking the link up here, and I'll also link it for you in the description below. The reason that people love real estate as an investment is because you can create, for the most part, predictable passive income. You buy a property, and to keep things simple, let's say you buy a house for $100,000, and then somebody moves into this house, a tenant, and this tenant is now going to pay you $1,000 a month every month for living in your house. But buying and operating your own rental properties is a little bit more extensive because one, you need to have access to the cash to buy the property, and two, you need to have the team built. So that means you need to have access to the real estate agents and the contractors and the attorneys and the accountants and the property managers, so it's more involved. This is where REITs come in handy because you can invest in a REIT, which is a company that is now going out and investing in real estate and making money through rent. The cool thing about REITs is that they are required by law to pay out 90% of their taxable income or their rent to you, shareholders, through dividends. REITs make money by buying real estate properties and then leasing them out to other people. That way they make rent. So now they take all this rental money that they get and they pay their bills, and now they take 90% of whatever money is left and they have to pay this money out to you and other shareholders through dividends. A dividend is a cash payment that a company gives you. So now instead of you going out and getting rent from a tenant, you are investing in a company that's going to manage the property and do all the work, and this company is going to pay you a share of their profits through dividends. REITs are a popular way for you to invest your money if your goal is passive income because REIT stocks tend to pay much higher dividends than regular stocks. Some REITs pay 10% dividends. That means if you invested $100, you will get $10 back this year just through dividends. But before you just jump in and invest in a REIT just because they're paying a high dividend, there are three things that you need to know. You need to know how dividends work, you need to know what kind of REIT it is, and you need to know what this REIT invests in. Before I get into what these three things are, I need you to do me a quick favor and smash that thumbs up button below, because if you don't, well, the way the YouTube algorithm works, if you do not hit that thumbs up button below, then YouTube will be much less likely to show our financial news and education videos to you and everybody else. When you invest in a high dividend paying REIT, what you'll typically see happen is that when a dividend is paid out, this is called the ex-dividend date. So when the dividend is paid out, you will typically see the stock price of the REIT fall by the amount of the dividend. So if a stock is trading for $200 a share and it pays out a $20 dividend, you will many times see the stock fall to $180 a share the day that the dividend is paid out. If it's a really strong REIT, you'll see the stock price climb back up because investors will use this dip as a buying opportunity to buy the stock. And when it comes to dividends, we have to talk about taxes. Dividends that you get from REITs are typically taxed differently than the dividends you get from regular stocks. Typically, if you go out and you buy a stock and this stock pays you a dividend, you get to pay a very low tax rate on this dividend called the long-term capital gains rate. This long-term capital gains rate is usually a lot lower than the tax rate you pay on the money you make from your job, which is called ordinary income. Well, the IRS says that you have to pay taxes a little bit differently when it comes to REITs. The government said, okay, because REITs pay out higher dividends, it's almost like another income stream for you, so we're not going to give you the long-term capital gains rate, which is a special lower tax rate. You have to pay the ordinary tax rate, which is the higher tax rate on REIT dividends. If you have an accountant or a tax software filing your taxes for you, this isn't really something that you have to worry about too much when you're filing your taxes because this should automatically be calculated. This is more something I just want you to be aware of so you understand how the tax game works. Now, I also do have to tell you that while I I am an attorney. I'm not your attorney. So if you have specific tax questions, make sure you talk to a tax professional in your area. If you want to see how big of a dividend that a REIT or any stock is paying out, you can use any stock analysis website, or you can use a free stock brokerage like our sponsor Webull. So if I go into Webull and I look up AGNC, which is the stock that I was showing you earlier, this is a REIT, and I open this up, I can see that they're paying out a dividend of $1.44 a share, which based on the current share price at the time we're recording this video is a 10.12% yield. Now I'm going to compare this to one more REIT. So if I come here to SPG and I open this up, I can see, okay, that this stock is paying out a dividend of $5.20 a share, and this is a yield of 8% based on the current stock price. Then if you find an investment you like, you can buy or sell whatever stock, REIT, or ETF you want right off of their app or your computer, and they don't charge you a penny to make a trade. It's free to create an account, and the best part of all is that Webull is giving you, Minority Mindset fans, a free stock valued between $800 and $1,600 when you deposit $100 into your account. So if you want to learn more and get your free stock, I got the link to where you can do that in the description below. Fair warning, I don't know how long this promotion is going to last, and Minority Mindset is a partner with Webull, so if you use them, we will get compensated, but there's no additional cost to you. It's free to create an account, they don't charge you a penny to make a trade, and they're giving you a free stock just for investing with them. So if you want to learn more, get started, and see how you can get your free stock, I got the link to how you can do that in the description below. Now, let's move along and talk about the different kinds of REITs, because you have two different kinds of REITs. On one hand, you have equity REITs. These are REITs that go out and they operate and they own real estate investments, and they have tenants that pay them rent. Then there are mortgage REITs, which invest in loans and mortgages. These mortgage REITs make money when landowners and property owners pay interest on their debt. Both type of REITs come with their own fair share of risk. I mean, the mortgage market is going to go through their own cycles, just like how the real estate market is going to go through their own cycles. And some mortgage REITs are going to invest into more risky loans, and some equity REITs are going to invest in more risky properties. You got to know what kind of investment you want. Being a mortgage REIT or an equity REIT doesn't necessarily change much when it comes to researching a REIT. It changes more of how the company operates. Like AGNC, which I talked about earlier, was a mortgage REIT, and SPG, which I also talked about, is an equity REIT. Again, I'm just giving you these REITs as examples. I'm not telling you what to invest in, but once you understand what the different kinds of REITs are, that's when you can look at what these REITs actually invest in. Some equity REITs, so these are the REITs that own and operate their own real estate, will invest in residential real estate, so apartments and homes. Other REITs will invest in hospitals. Other REITs will invest in office space. Other REITs will invest in malls. Ask yourself, if you had an unlimited amount of cash, what kind of properties would you want to own? You do not, I repeat, you do not want to buy into a REIT just because they're paying out a high dividend. A really high dividend yield could mean that a company is making a ton of profit and the stock price hasn't caught up to it yet, which is good. And it could also mean that the stock price is tanking because the company is having a problem and the dividend hasn't adjusted yet. That is bad. With mortgage REITs, you got to look at the same thing. Some mortgage REITs will invest in mortgage-backed securities. Some will invest in commercial loans. Some will invest in commercial mortgage-backed securities, and others will invest in high-risk mortgages. The mistake that a lot of people make when they invest in REITs, and this happens for any stock for that matter, but especially in REITs, is that they think that they're investing in a ticker symbol as opposed to a company. They think, wow, this stock is paying out a 10% annual dividend. Let me just throw all my money into the stock because I'm going to make 10% of it back every single year. But if you're getting a 10% annual dividend while the stock price is falling 20% a year, you are in a losing situation. But if you know what you're doing, you have the opportunity to win twice, because now you're going to invest into a strong company, which means your dividends are going to go up because they're making good acquisitions, and the stock price is going up because the company is becoming more valuable, so now you're winning twice. Now, if you've made it this far in this video and you're thinking to yourself, man, I would really like to invest in REITs, but I don't trust myself to do the research, or I don't know how to do the research, or I just don't want to spend the time doing this research, then you may want to consider investing into a REIT ETF. An ETF is a fund that invests in a whole bunch of different stocks. So now, instead of you going out and trying to find the best REIT to invest in, you can invest in a REIT ETF, which is an ETF which invests in a whole bunch of different REITs. This would be like investing in VNQ. Again, I'm not telling you what to buy, just giving you an example. VNQ is an ETF that invests in REITs. So now, if you bought shares of VNQ, you will have exposure to 180 different REITs, because VNQ is a fund that invests in more than 180 different REITs. So REITs are a way for you to get exposure to the real estate market without having to actually manage and operate your own real estate investment properties. And unlike crowdfunding, funding, REITs allow you to access your money whenever you want. And like with everything else, if you want to make the smartest decisions with your money, it helps when you're staying up to date on what's happening in the finance and business world. And if you're looking for an easy way to do that, well, that's why we created the free Market Briefs newsletter, which is our Minority Mindset Finance and Business newsletter, where our team first breaks down the top finance and business news, and then we show you how this news affects your wallet. That way you can be smart with your money. This Market Briefs newsletter is completely free, and you can subscribe to our newsletter by clicking the link up here or by clicking the link in the description below. By the way, our financial news emails are separate from our financial education emails. Now, before we get into the next clip, I do want to let you know that if you are interested in learning more about money management and investing, our team has put together an amazing guide that will walk you through the things you need to know about managing your money and starting to invest your money the right way. That way you can build your wealth. This guide is completely free when you sign up for our daily newsletter. So if you want to download this free guide and start reading our daily newsletter, I got the link to how you can download it for free in the description below. The thing that makes our stock market right now more unique than ever before, besides just the crazy roller coaster that we've been seeing, is that we have more retail traders, more non-professionals investing their money on the stock market right now than ever before, which is why you have articles saying things that millennials are changing the stock market. Now, I'm a money nerd. I've been here on YouTube telling people to invest their money and be smart with their money for years. So I love the fact that people are opening their first stock brokerage accounts. I love the fact that people are getting interested in investing. I love the fact that people are getting interested in learning about companies and investing their money into companies instead of just spending all their money at companies. But there are some risks here that I want to make sure we're on the same page on. That's why in this video, I'm going to be going over the reasons why millennials should not be buying stocks. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below. And I also have some exciting news because this year I am going to be the keynote speaker at FinCon in Austin, Texas. FinCon is the largest financial media conference in North America. So if you're interested in finance and media, if you're a YouTuber, a blogger, a podcaster, and you want to come hang out, you can join me in Austin, Texas, September 22nd to the 25th. So I got the link to how you can join that in the description below. And I also have a discount code that you can use. If you type in FC Minority Minds, you're going to save some money as well. So if you want to come hang out, I'll see you in Austin, Texas in September. If you are a millennial, the first reason why you should not be investing in stocks is if your goal is to get rich quick. We saw this massive boom of retail traders. Retail traders are people who are not professionals. So we saw this massive boom of retail traders as soon as the pandemic hit because everything was shut down. Casinos were shut down and people had nothing to do. And so now you had this kind of new wave of people that were like, maybe instead of me going to the casino, I can start throwing my money in the stock market. And so a lot of people started investing their money in stocks and a lot of people started making money very quickly. And so this has given some people a perception that you can make money very fast in the stock market consistently, which is not a bad thing. Yeah, you can make a ton of money in the short term in the stock market, but it is nearly impossible to consistently get huge returns year after year after year in the stock market by being a trader. You remember when the whole GameStop saga happened, right? We had some smart people that realized that GameStop was so heavily shorted, so they came in and they started buying. Then they started posting that they were buying the stock that was heavily shorted on Reddit. And then you had all of these other people that started buying GameStop, not because they believed in the short squeeze, but because they were just hoping to get rich quick. Now, I get it. Part of it here was to give the middle finger to Wall Street, which is fine, but you also had a lot of people that were buying just to get rich quick. You saw the same thing with currencies like Dogcoin, Dogecoin, Dogecoin, whatever you want to call it, because people are buying this coin, which started off as a meme, just because they're hoping to get rich quick. And so you have a lot of people in the market that are leveraging up their investments, hoping to make a lot of money very quickly. Now, I'm going to say this again. You can make a ton of money in the short term. You can make a lot of money trading stocks in the short term. But if you want to keep this money and you want to grow this wealth over the long term, there's a different strategy for doing that. And that's not trading stocks. The thing that I'm worried about more than anything else is that between 2020 and 2021, we have seen the stock market after the crash pretty much go up straight like this. And so you have a lot of people that have seen a lot of gains. And everybody is a financial genius in a bull market because all they've seen is stocks go up. And so everyone gets kind of like envious because they see all their friends making a lot of money and they see all these random people on the internet making a lot of money. So they think, why can't they do it too? And then you throw your money into random stocks, you see it go up and you're like, wow, I'm pretty good at this whole stock market thing. And when everything is going up, it is easy to make money. But as things slow down, that's when you can see who's a good investor and who's a bad investor. investor. Or as Warren Buffett likes to say, when the tide goes out, that's when you see who's been swimming naked. The reason why I bring this up is because long-term investing has never been the attractive thing to do. It's never been the hot thing to do. It's just one of those things that can make you money over the long term. The hot thing to do is to be a day trader, to find the hot stocks, and to throw your money in there and hope for double your money very quickly. And that's good if you can do that. But we have this kind of whole generation of people, maybe not a whole generation, but you have a lot of people that have this kind of belief that making 100% returns is completely normal in 6 months or a year. And so people look at 7% returns in a year and think, what the heck is 7%? And this is my concern, because people have kind of gotten into this gamification gambling mindset of investing, because a lot of our newer stock brokerage apps like Robinhood, they have gamified the stock trading process, because now when you purchase a stock, what happens? You get confetti, and so you feel like you're playing a game. And so we have this kind of gamification where people think I can make a lot of money very quickly because people have been making a lot of money very quickly. But this is kind of just what's going on right now. No market can go straight up forever. And so if you get caught up in the belief that you are a genius trader because you made a lot of money over the last 12 months and all you've seen is a market going like this, and you just keep leveraging up your bets and you just keep making risky trades because you keep doubling your money very quickly, eventually you get to the point where you roll the dice one too many times and now you lose. And this brings me to the second reason why millennials should not be investing in stocks is if you are not prepared to lose mentally. Every successful stock market trader will tell you that making money in the stock market is just as much strategy as it is psychology, because if your mind cannot handle seeing your portfolio in the red, or if your mind gets greedy when things start to go up, you will not have a chance to make money. And if you do make money, you will not be able to keep that money because now you get greedy. Everybody, even Warren Buffett, loses money on certain deals. It's just a part of the process, okay? You have to accept that if you want to be a trader or an investor. Now, once you get over that, you're going to have to go through a few losses. That way you can learn. It's just the tuition of being a stock market trader or investor. This one sounds easy in theory, but it's a whole lot harder to practice. Because if you invest a lot of your savings into the stock market and then you see your stocks go down 10%, all of a sudden you saw your $10,000 go down to $9,000. And if it keeps going down, you start to panic. It's very easy to glorify the stock market wins, but a lot of times you don't see the pain that it takes to get there. Like everybody talks about Amazon. They say things like, if you just invested $1,000 into Amazon when they first went public, you would be a multi-millionaire. But what they don't tell you is if you would have invested that $1,000 in Amazon, you would have also had to see your $1,000 investment drop by 90%, and you would have had to still keep your money and not lose faith and not panic and not sell. Not a lot of people have that mental discipline to see their investments fall by 90% and then still stay in the game because they believe in what they're investing in. Now, don't get me wrong here. I'm not saying that you should hold every investment no matter how far down it goes. You got to pay attention to your investment. You got to pay attention to your company. You got to know what you're investing in. Sometimes a company is going to go bankrupt and you want to get out as fast as you can. But what I'm trying to get at here is there's a lot of emotion that's involved with stock market investing and stock market trading, and you got to understand that going in. And if you're not able to handle that emotion, you should not be trading stocks. If you do still want to be involved in stocks and you know that you emotionally cannot handle that, then you should be a passive investor. Passive investing is where you find a few ETFs and every month or every couple weeks you just deposit some money into these ETFs and you never look at it. You just let your money grow and compound over time. So you have to know and understand yourself. If you are interested in learning more about passive stock market investing and some of the different types of stock market strategies that there are, our team put together an amazing stock market PDF that will walk you through that. This PDF is completely free when you sign up for our daily newsletter. So if you want to download that PDF, I got the link to how you can do it in the description below. And the third reason why you should not be buying stocks if you're a millennial is if you do not have the money to invest right now. The first thing you got to do is give yourself a basic savings cushion. So if you don't have at least $2,000 saved up in a savings account, do that first, because life happens. Sometimes your car is going to break. Sometimes your AC is going to go out. Sometimes your window might break. So you want to make sure you have a savings cushion, that way you don't have to go into credit card debt when an emergency happens. The second thing you got to do before you start investing your money in stocks is you want to pay down your high interest debts. These are things like credit card debt. Because if you're paying 15% a year to your credit card company and the stock market on average grows by 8 to 10% a year, you're going to get a better return by paying down your credit cards than you will by investing your money in the stock market. Plus, investing your money in the stock market has risk versus paying down your high interest debt is a guaranteed return. So it is not worth it for you to start investing your money in the stock market when you're getting skinned alive by a credit card company. Once you get those two things squared away, the next thing you want to understand when it comes to putting your money in the market is you do not want to invest more than you're willing to lose. In 2020, I made a video. This was super sad when it happened. It was a 20-year-old kid, and he started trading money in stocks, and he was trading options, and he was using leverage, and something happened with his account where he thought he was down hundreds of thousands of dollars, and because that happened, he felt like there was no escape. He thought he'd never be able to pay this money back, and so he took his own life. And so money is real. Stock market trading is real. And so you got to understand that if you're investing your money in the market, this is money that you might not get back. There is a risk to investing your money in the market, which is why I always say that investing your money has risks. You are never guaranteed to make money when you invest. You might even lose money, which is why you should always do your own due diligence and never blindly listen to a random guy on YouTube. There's a lot of crap out there on the internet with people promising these hopes of super high returns. And all you got to do is start with $100 or $1,000. And now you can leverage up your investments 10-fold or 20-fold. And now you're using all this debt. And you've never traded money before. And you just think that if you just use all this debt, you're going to be able to make so much more money because now you're using other people's money to trade stocks, even though you're not good at trading stocks yet. And so now you are using all this money that you don't have, that you cannot afford to lose. And now if you lose, not only do you lose your own money, but you owe money to your broker. The first thing you got to do is you got to get your personal finances in order. Second, when you start investing or trading for the first time, use your own money. Learn how it works. There are ways for you to use debt strategically in the stock market. You see institutions and professionals do this all the time. That's how they can make so much more money because they're using millions of dollars of other people's money. But before you get to that level, you got to understand how the process works. You cannot compare yourself at level 1 to somebody else's level 200. I want you to be a smart investor that can make money now and that can keep your money and compound your wealth over the long term. And the only way that you can do that is one, if you understand how to use your money and if you understand how to invest your money the right way. And so when you come in, you got to understand how the process works. So don't go in and start throwing in all this money that you cannot afford to lose right now. And one of the easiest ways to do this is just to think of the money that you invest as gone. Think of this money as it just disappeared into thin air. Now, if you do that and you make money, now you just found brand new money. And if you lost that money because you're learning, well, you already told yourself that you had lost that money and it's not going to hurt as bad. Now that you understand the reasons why you should not be buying stocks, let me go over the reasons why you should be buying stocks. That way you really understand where you fall in this kind of equation. The first reason why you should be buying stocks is if you want to grow your money. Notice how it didn't say get rich quick. And there are ways for you to make money in the short term. And there are also ways for you to make money over the long term. But if your goal is to grow your money, you can do that through the stock market because now you can take your money and invest it into companies. So you own a piece of these companies. And as these companies grow, so do you. And this brings me to number 2. If you want to invest your money in stocks and do it successfully, you also have to have a strategy when it comes to growing your money. So kind of like I mentioned before, there's a couple different ways that you can make money in the stock market on the broad level. You can make money over the long term, and then you can make money over the short term. So your short term people are your traders, your long term people are your long term, more kind of fundamental investors. Let me go a little bit deeper into these. When we talk about making money in the short term, this is when you're buying and selling a stock within less than a year. There's a whole bunch of different short-term investing or trading strategies here. You have day traders, you have people that are looking at momentum, you have people that are swing traders, and so you have dozens of short-term strategies. And so you want to find the strategy that's best for you. So when you think of short-term trading, these are the people that are looking at stock charts. These are the people that are looking at those candles and those really crazy and fancy looking charts because they're trying to find the next kind of breakout, the next opportunity where a stock is going to rally very quickly. With this short-term trading, you can make a lot of money in the short term. And you have to understand that in this, there's also more risk because you're looking at things, you're looking at momentum, you're looking at charts to see where you think the stock is going to go over the next 3 months, over the next 30 days, or over the next 3 hours. Here on the long-term side, you don't really care too much about the charts. If you are a long-term trader, what you're looking at is the underlying value of the company. You're looking at the numbers now. You're looking at the fundamentals. You're looking at the profit. You're looking at the revenue. You're looking at the cash flow. You're looking at the new products that are coming out. You're looking at the executives. So you're looking at a company and you're looking at, okay, I think this company has a lot of room to grow in the profit, and I think at its current stock price, this company is undervalued. I think this company is worth more than $3 billion or whatever it is right now. And so because of that, and because of the new future potential, you want to invest in this company, and you're going to invest it for the long term, which is at least 1 year. Many times when people talk about a long-term analysis, this could be in a decade or multiple decades. And so when you're looking at companies and you're buying them for the long term, you want to find an undervalued company and hold on to it for a long time. And so even if a company goes down, you're not going to be selling here because you believe in the long-term value of the company. Now, you want to make sure that you're keeping up with the earnings calls. You want to make sure that you're keeping up with how much money this company is making, because if something changes, then you might want to change your strategy. But the issue that so many new investors and traders have is they don't understand the difference between long-term investing and short-term trading. And so what do? They come in and they think, okay, I'm going to find some great companies that I believe in, and I'm going to be a long-term investor. And then something goes wrong. The stock starts to go down a little bit, and then they panic, and then they sell. Now, all of a sudden, you went from a long-term investor to a short-term trader because you panicked and you sold. So it's a psychology, kind of like what I talked about before. And so you have to understand, if you are a long-term investor and nothing has changed fundamentally, just the stock price has changed, then you got to understand where you are in this equation. Likewise, here, if you are a short-term trader and you're looking to make money in the short term and this company shoots up 50%, now you tell yourself, yeah, I hit my goals of where I wanted to sell, but I think this company is really good and I think the stock is going to continue to go up, so why should I sell right now? And so you hold on to your stock longer than you think, and then what happens is the stock price corrects because it went up way too fast, way too quickly, and then the stock price starts to go down, and now you lost out on a big chunk of your profits. What you have to understand is you can be right about a company and still lose money. And so when you're investing your money in the stock market, you got to understand that stock prices don't always equate to what's going on with the company right now. And so if you're investing your money here or here, you have to understand what's going on in the stock that is different than the company, which is why your strategy is so important. And you have to know this before you actually go in, because you want to know when you're going to sell and what is going to be your kind of risk parameters, because if things start to go bad, are you going to sell? Here, if the stock price goes down, you might not want to sell it because that might be an opportunity for you to come and buy more. But here, there has to be an exit strategy, because if you're investing for the short term, you don't want to get in love with the company. You're just trying to make your profits quickly. And the third reason why you should be buying stocks is if you are ready for the emotional roller coaster. If you're ready for the ride, you already beat half the battle when it comes to putting your money in the stock market. Now all you got to do is figure out your strategy. Are you a trader? Do you have time for that? If so, what is going to be your short-term strategy and how are you going to follow through with it? If not, then if you're going to be a long-term investor, what type of companies do you want to invest in? How do you find these investments? If you don't want to put in all the work to find the right companies, then you can invest in ETFs. An ETF is a basket of stocks. That way now you don't have to do the work to keep up with one company or two companies. Now you can invest in ETF where you have exposure to a whole bunch of different companies. And you have ETFs that give you exposure to the whole stock market. You have ETFs that give you exposure to certain sectors like the tech sector or the healthcare sector or dividend ETFs. And so once you know what type of strategy you want, now it's all execution. But this is one of the toughest battles that most people do not talk about when it comes to putting your money in the stock market, because you have to be mentally ready for the war that you're going to fight when things go up and when things go down. Because when things go up, you don't want to get greedy. And when things go down, you got to know when it's time to sell and cut your losses. If you enjoyed this video, here's a video on how to start investing in stocks that I think you'll love. And while you're at it, download a free stock market PDF. And as always, keep hustling. But in the long run, what really affects the stock's price is its fundamentals. That's how much money is the company making? How are their profits looking? Are their revenues growing? Are their profits growing? How is the management, and are they innovating for the future? So these are the things that really affect the company's stock price over the long term.